Interactive Brokers would like to take a moment to welcome Paul J. Marino and Elliot Frank of Sadis Goldberg. This is a leading New York-based law firm which practices in both hedge funds, private equity, venture capital, commodity fund formation, family office, real estate, transactional account counseling, compliance services, regulatory defense, litigation, derivatives, tax, ERISA, and estate planning. Paul is a partner in Sadis Goldberg in the Financial Services and Corporate Group, where his practice focuses on matters concerning financial services, corporate law, and corporate finance. Mr. Marino provides counsel in the areas of private equity funds and mergers and acquisitions for private equity firms and public and private companies in private equity fund and fund formation. Paul earned his JD from Brooklyn Law School, and he's registered to practice law in New York, New Jersey, and Connecticut. Elliot Frank is a partner and joining us today from Sadis Goldberg's Regulatory Compliance Group, where his practice focuses on day-to-day strategic, legal, and compliance matters relevant to hedge funds and asset managers, including regulatory initiatives, current and planned fund product offerings, securities and investment matters, and marketing activities. Elliot earned his JD from Ohio State University School of Law, and he's registered to practice in the state of New York. Sadis Goldberg has been in operation since 1997, and the firm is committed to excellence in the practice of law and is devoted to developing strong client relationships. They also provide ongoing compliance, investment, and legal services to operating fund managers. In today's presentation, Paul Marino and Elliot Frank are going to explore how you can use your hedge fund's legal and compliance documents to help you to attract investors and to protect you from regulatory and reputational risks. Paul, please take it away.
Okay, thank you so much, and thank you, Amanda and Cynthia and Interactive Brokers. Today we're going to go through if you notice, the slide deck is pretty extensive, so we're not going to cover absolutely everything. That would take quite some time. But what we're going to hit is some of the high points, and we're going to go through what we believe some of the issues that you need to know, so you can use what you need to have is your compliance, and you can use your compliance as a means not only, and we say as a shield, right, to protect yourself from liability and otherwise, but also as a sword, as a means to be on the offensive and try to go out and use it to attract capital and attract investors. I'm pleased to have Elliot with me, who's an expert in the area of compliance, and he and I will be going through this. Again, as I'm going through the slide deck here, if you have any questions, you please type them in, and we'll try to get to them as soon as we can. If there's a particular question that you ask that is very unique or specific to perhaps your fund or what you're doing, and I don't talk about it online, take note. I'll try to get back to you on it either today or tomorrow, or Elliot will, and we'll follow up with you. Again, thank you again for joining, and let us begin. So if you notice...
Well, Paul, if I could jump in for just a moment, in the upper left-hand corner of your screen where the display settings, would you put this into full screen? One left to that. There you go.
Better? There we go.
Perfect.
All right. Great.
Take it away. Thank you.
All right. Let me just move this over. Okay. Hold on a second. There we go. All right. So, if you notice on our first slide, and I'll pull it up here, that's our disclaimer. We are attorneys, so we have to have that. All right, so what is the origin of the term hedge fund? And I always include this in here because a lot of folks get this confused. There is really no regulatory or governing law that describes what a hedge fund is. The first hedge fund was created, what most people believe was established in 1949 by a fellow A.W. Jones, and he employed a hedge concept which made his fund more or less market neutral. And generally what he believed in is that no matter if the market goes up or down, right, his strategy should both protect the investor from a downside risk and create alpha, which is where the next slide here is the 3 A's. And again, the reason why we're talking about this just quickly is I truly believe that you need to know as much as you can about your product, and that includes compliance. And one of the things that you should know is when you're talking about what your hedge fund or what your SMA, whatever your strategy is, the 3 A's are alternative, absolute, and alpha, right? So alternative, it describes the nature of a hedge fund and their typical or atypical investment trading strategies, right? So that's a different type. You're different than a standard index fund or otherwise. Absolute, you get an absolute return. A lot of managers will create some type of a correlation to an index or otherwise, but in the true sense of the word, right, you're supposed to have as close to zero correlation as possible. And then alpha, right? So without getting into economics, there's simply the portion of the return that's independent from the market's performance. In other words, that which is attributable to the skill of the hedge fund manager, right? So know your investor. We just actually wrote an article about this that'll be published on our website. But know your investor. You should really know what your investors are looking for. And generally, on a smaller scale, you're going to be looking at investors that are either accredited or qualified, and we'll talk about that in a second. And then there's a kind of an institutional. And an accredited and qualified, and let's group family offices in there, they're going to have a different mindset and a different investment thought processes than perhaps an institution will. An institution such as if they're ERISA-based, or a municipality like Texas Teachers or whomever, right? So when you're going out and soliciting your investors, right, know who the investor is, okay? So know your investor. Are they institutional, etc.? Are they subject to ERISA? All that will come into play. Are they tax exempt? All that will come into play in your structuring and your compliance, okay? So accredited investors, that's generally the lowest threshold in private funds. And I have the definition in here. And you should know that if you're registered and you only have accredited investors, if you're a registered RIA, then you're not going to be able to take a performance fee from the accredited investors. They have to be qualified. So a qualified client, and here's the definition of qualified clients. And again, you're going to be able to get this slide deck after the webinar is over. You're going to be able to download it, and there's a lot of really good information in here. We always recommend that you seek, at a bare minimum, that your clients are qualified clients for no reason other than the fact that I know, none of you would ever purposely lose anybody money. But if you did lose people money, that at least they can absorb it. They can absorb the loss better. A qualified client that just has more money. Compensation, performance and management fees. Now, there's been a lot of pricing pressure on it, on both incentive allocations, your performance fees, and management fees. What I have found is most investors are more apt to balk at management fees or higher management fees than they are at performance fees or incentive allocations. And just, the traditional model has been 2 and 20. And just as a side note, that actually came out from the oil and gas industry years ago, where wildcatters would want to get compensated more for their efforts in finding oil. And if anybody's ever invested in that space, you know how risky that is. So performance fees, incentive allocations, know where the market is on it. I also have a blurb in here about hurdle rates. Now, generally, hurdle rates are more of a private equity instrument, not necessarily in a hedge fund. But I have seen them creep into more and more documents. Try to stay on top of it and ask your attorneys or your auditors and whomever, ask around and find out what exactly the trend is with fees or otherwise, okay? Remember, you're taking somebody else's money, you're managing their money and being compensated for it. Obviously, they want to see a return, okay? High watermark. A high watermark, for most of you, if you have a fund already, you know what this is. But for folks that are thinking about starting one, a high watermark is simply year one, and I have this defined in here, but it's for your performance fee. Year one, you're at 10. Year two, you're at 8, right? You're below the high watermark. Year two, if you're at 12, you're above the high watermark. And generally, you're only allowed to collect performance fees when you're above the high watermark after the first year. And there's a little bit of some information here on catch-ups, where that has been a trend, especially when the market really turned down and people were underwater, where they could get a percentage of their performance fee if they get back over a certain threshold. All right. Some common mistakes. Don't assume that having traded a large hedge fund or a bank makes you a great hedge fund manager. There's a lot that goes into it, right? Don't believe that investors will ignore your lack of pedigree. The truth of the matter is that in today's world, kind of the post-Madoff world, unfortunately, your pedigree really matters a lot. People are looking at it more than they ever have. And the reason why is because they can't take a reputational risk, right? Reputational risk will kill a lot, especially institutional investors. So it's a very big thing. In fact, what we do here is if you sign as a client with us, we'll run a full background investigation on most of the managers, specifically the folks who are really involved in running the fund. And the reason why is twofold. One is we want to ensure that everything you're telling us is accurate and truthful. And two is to unearth, you never know, you might have had something happen in your 20s or what have you, to unearth any information that you might have forgotten about and neglected to tell us. And that information has to be disclosed. Again, the last thing you want to do. Elliot, you want to say something?
I was just going to add that it's critical in that case. Disclosure is critical in this industry, and it's not just the regulatory requirement that you disclose that sort of information, but also our concern and what Paul was mentioning as far as knowing the background of the manager and the people that work there. Is it also allows you to get in front of those issues. In today's environment, especially post-Madoff, but in today's sophisticated investor environment, due diligence meetings, due diligence questions are going to have an added weight for your investors to write a ticket to you. And they're not going to commit that capital until they're certain that they've vetted you fully.
Okay. And here, don't fall for the misconception that running a hedge fund, however small, is glamorous, right? It's a business. At the end of the day, right, you're running a business, and you have to. And that's the reason why a lot of managers stumble when they roll out of larger places, because they've never really even turned the computer on before. They've never reconciled their books. They don't understand exactly, other than trading, they don't understand the business aspect of running a fund. Okay. Let's see. Communication. Explain to your investors how you intend to make them money. What are you doing? What is your trading strategy different? And stay in touch with them. Don't just take your subscriptions in and then just go and hide, or take your subscriptions in and don't speak to them again. Describe the competitive advantage or key differences. People say your edge. What's your edge? Right? Every seeder that I know and that we deal with or represent, every fund of funds that we deal with and we represent, they want to know what your edge is. They want to know how you're different and what makes you different. Okay. Know why an investor should choose you instead of a more established manager in the same industry or same strategy. Establish credibility by outlining the organization and management experience in your marketing materials. And again, just stay in regular communications. And again, not just in good times, right? When things aren't going right, if things are going kind of sideways, or that you took a beat down in a particular month, right? Let your investors know, here's what's going on, here's what happened, and here's how we're going to adapt. And we're listening to you, we understand. One of the things, and just get back to establish credibility by outlining organization and management experience in your marketing materials. A lot of your credibility is going to come from the fact that you know what's in your docs. You know your compliance program. You know how things are run. And if you were meeting with somebody and you're asking them for the privilege of running their money, and you don't know everything that goes on within your funds, how trades are routed, when you're using Interactive as your broker, your prime broker, and you don't understand how a trade it goes from you clicking a button through your OMS into Interactive, etc. If you don't understand that, you should. You don't have to be an expert, but you should know everything there is to know about what you're doing in your business. And that's why you're going to get, if you don't understand your compliance materials, I'm going to get to that in a second. If you don't go through it and you have a good understanding of it, and don't sell it while you're meeting with folks, you're going to get tripped up, because the more sophisticated investors are going to start asking you more and more questions about that, especially once you get through the initial round of interviews with an investor and you get to their operational due diligence fellow. Okay? Treat investors like true partners and customers. I know a lot of you know all this stuff, but I think we forget often right, Elliot? We forget often that you're running a business. Elliot was GC at a pretty big fund for quite a few years after he left the public practice and went private into a company. And he'll tell you, you have to know as a manager what goes on inside your shop. Would you agree?
Yes, I think the focus of this webinar, as we build the foundation for the discussion, is just that. It's that I've spent over a decade working on the buy side as a general counsel and chief compliance officer at a few different hedge fund managers, and the common thread that runs through all of them is the expectation of the clients and the client investors. What I've seen over the years is an increased focus by investors and potential investors, not just on the investment strategy itself, not just on who the manager is, although those, as Paul pointed out, those are critical and essential, and those are what get you the meeting. But once you have the meeting, the investors really want to understand what you are doing to protect them and how you're doing it. And in my experience, as I started in practice in this area years ago, originally compliance was viewed from the business side, from the investment team, as sort of a cost center and expense and a requirement from the regulators. And that's true, it is a requirement from the regulators. But it has evolved, it's morphed over the years, and it has become a key component to your sales pitch. Investors now know what to ask in due diligence. They know what to look for when they're first approaching you, when they're doing a deep dive on you before they write that ticket. And without that infrastructure in place, you're going to lose that ticket to somebody else that has it. And that's really important to the way you approach your marketing with your clients.
Correct. And like I said, if you see in slide 12 that I still have up, treat your investors like true partners or customers. Treat each investor in a fair and equitable manner, right? And we'll talk about that quickly and some of the compliance. But right, Elliot, you'll get certain investors that call up that want to know information that you haven't disclosed to everybody, right? You have to treat everybody the same.
That's right. So to the extent that you have conversations with individual investors once they're investors, yes, it's perfectly okay to discuss your investment ideas and your outlook with your clients, but you have to make sure that you're not providing any particular client with greater transparency than you are to other clients. You do have a duty to disclose. So to the extent that you are having that conversation with a client, you should limit it to the things that you are comfortable sharing within, say, your monthly or quarterly letter, and the various ideas you have. If it's something that's more material, and materiality is really the issue here. If you raise a point that has a material impact on whether an investor would want to make a redemption from your fund, for instance, then you need to make sure that you've disclosed that information to all of your investors. If you provide that information, that transparency to only one, you could be risking disadvantaging your other investors, and that you would be in breach of your fiduciary duty and your obligation to protect and treat all of your investors equally.
Yeah, and another thing here, a bullet point we have here is, invest your money in the strategy and aligning your interests via skin in the game, right? It's a strong selling point. It's not necessarily compliance, but it is a strong selling point, and it allows your investors to know that you believe in your own self, that you believe in your strategy. If you're going to take a bet, you always bet on yourself, right? If you're going to believe that somebody's going to do it, you can do it. Let's go over here again. All right. Willingness to provide transparency, and that's why I wanted to talk about quickly. And this starts to really start getting into compliance a bit. Transparency is absolutely critical to mitigate concerns of fraud and risk, right? The unknown is probably the worst thing for an investor. An LP is going to be thinking about, whatever, besides just your returns, an LP is going to be thinking about, what else is going on? Why are things going sideways? Why are things going great, or what have you? Define your risk management controls, targets, guidelines, portfolio, and position risk measures. All right, provide weekly, monthly, annual performance estimates, schedule calls and access to investment teams, provide annual audited financial statements. Everything you do, right, should be done in a manner that is consistent, right, and evenly applied at all times, right? So you apply the same basic thought process. Go ahead.
Yeah, so Paul, I just thought I'd jump in. Some of this is obviously mandated by regulatory requirements. The audited financial statements and other types of custody-related issues are regulatory in nature. But a lot of this, especially that first bullet point where you define your risk management controls, your guidelines, your portfolio and position risk measures, those aren't necessarily specifically regulatory requirements, but what those are part of your broader culture of compliance. And that's sort of one of our key takeaways is everyone here, everyone on this call, if you are organizing yourself as a business to be a registered investment advisor, an ERA, or what have you, if you are running other people's money, you need to make sure that you have a culture of compliance from the top down. And when your investors meet with you, especially when they're potential investors, they're not actually invested with you, but could be contemplating it. They will be thinking about these things. They want to know that you have in place back office infrastructure, that you have these concepts in mind, that you have defined controls both on cash flows, on investment decisions, on allocations, on portfolio limits, on stop loss limits, things of that nature.
And you have to be able to talk through it. And the bigger you get, you might be one or two levels away from that person, or if you're big right now, you may be one or two levels away from that transaction, that risk officer or what have you. But you need to be able to talk through it enough where you're credible enough and you have a good understanding of the basics of how you're doing it.
But and then the one thing we do caution, obviously, is if you do talk about these things or you do bring these things up in meetings, they must be correct. So don't speak off the cuff. If you're not sure about a particular risk limit or a stop loss limit that you have or a exposure sizing limit that you may have in place, it's okay to tell an investor that you'll get that information and get back to them with it. But you must be absolutely certain that the information you provide any investor is truthful and accurate and is fully disclosed. So
either written or stated verbally. Right. And remember that it's a key component. Because I can't tell you how many times, right, Elliot, that we've seen where a manager will get into trouble because they said something they weren't sure about. Turns out it wasn't 100% factually accurate. The investor hangs on to that, and then of course their account goes down, and then they say, well, you told me you could liquidate this position in 2 hours, when in fact it was a thinly traded position that you couldn't liquidate in 2 weeks.
Absolutely, and it's not necessarily fatal. If you do provide misinformation or inaccurate information to one of your investors, the best remedy to that is to update them, preferably something in writing that you can point to show that you misspoke, and you can provide that information. One thing that I do advise, even to smaller managers, and oftentimes this is seen, again, this gets to the concept of a cost center, but it really helps your business, is an operational due diligence document, that you should have a DDQ for your business. It's not just on the operational side, but also on the investment strategy. And we can help you prepare something to prepare your DDQ. But there are standard forms available out there in the marketplace for DDQ documents. And what they do is they allow you to get all of the information about your business amalgamated into one document. And not only is that something you can give to investors, and that if they see that, they see that you're ahead of the curve, that you're doing something more institutional in nature. So it gives them a better feeling that you are a more sophisticated and business-minded manager. But it also gives you the ability to have all that information at hand. So if an investor asks you those questions, what are your risk limits? What are your position and exposure limits? You can point to the page in the document that shows those things. And
it helps you focus. It focuses your talking points, and it gives you a guideline to deal with your potential investor. And again, don't think, right? I mean, there are a whole group of people out there that want to say that that are being paid by an investor to say no, right? And they want to find holes and poke holes because that's how they buy their kids Christmas presents, right?
I mean, that's a very good point.
That's basically it.
That's a very good point, Paul. What I hadn't mentioned, what Paul just brought up, is higher net worth individuals who have the means and who are active in the alternative asset space oftentimes don't do their own due diligence. They hire a third-party consultant that will come in and do the due diligence meeting with you and meet with you. Don't ever forget that that person is working for the potential underlying investor, but that person also, as Paul just pointed out, wants to add value to that investor. So they are looking for reasons to write up a report that shows either inconsistencies or lapses within your organizational structure or your compliance program. You don't want to have that exposure. You need to view your compliance infrastructure, your compliance manual, your DDQ, all of these things as part of your marketing documents. They may not be part of your marketing deck, but they are absolutely critically important to you to attract investors in the current marketplace.
No doubt. So I just switched to Regulations Investment Company Act. I'm not going to really go through this, but for the most part, you know, you're gonna, if you have a fund and you're right now you're either a 3C1 or a 3C7, and those are, I have the definitions in here. You should know the difference, and you should know where you fit. Okay, because it'll dramatically impact how many investors you can get into your fund or not. Okay. 3C1, we have another good definition. We flesh it out a little bit more. 3C7, same thing here, right? Many smaller funds aren't going to hit the 3C7 threshold, right? For a host of different reasons. But so most of you will be most people are 3C1. But if you do become a 3C7, or you can bifurcate your funds when you have two different types of investors, you are allowed to do that. So you could run it through. Go ahead.
Well, I was going to say there is a tremendous amount of information in this slide deck. We viewed this as sort of a resource since it will be distributed to you after the webinar. We felt that adding a lot more flesh on the bones as far as detail was something that the participants might find valuable. So the fact that we are skipping ahead and jumping to some of the more compliance-specific slides, don't feel like you missed anything. The slides that we do skip are slides that have information that's useful to you, but you'll be able to look at that at your leisure after the webinar.
Right.
So I was thinking maybe we turn to some of those.
Yeah. So here's one I just want to talk quickly with you, and let's begin with this. Marketing blue sky, right? So your marketing docs. Let's talk about that quickly, right? So your marketing docs. Let's talk about one thing that goes into your deck, and I'm going to specifically ask you this because I know it's a big issue for a lot of folks out there. Your performance, right? How are you gonna? I've been running my own portfolio. I've been running a small portfolio for 3 or 4 years, 5 years, right? My performance has been outstanding. How can I get that into my marketing materials, and how can I make it work?
So there are a few different approaches. It depends on how you were doing it, what your structure was when you were doing it. And everyone's facts and circumstances are different. But generally speaking, the SEC's approach or view on this particular issue, it's the past performance. It's also relevant, for instance, if you were at a different manager, for instance, and you go off on your own to start your own fund.
Well, let's hold that thought for a second. Let's just go to the guy who has not been at a bigger place, and then.
So it's the portability of performance. So the issue is, if you are going to cite that performance, it's irrelevant from the SEC's perspective. It's irrelevant unless it's and shouldn't be used unless you have a strategy that's substantially similar, virtually identical to what you are offering to your investors. So if you were managing, say, your own money for a period of years, and you were doing it in accordance with a particular strategy, so long as that strategy is an accurate or aligned strategy with what you are offering to the investors, then you can show that performance. You do need to show that performance net of fees and expenses that an investor would pay. Now, obviously, if it was, say, your own money, you weren't charging yourself fees, you would have to then go back on a pro forma basis and show those returns, not gross, but net of fees and expenses.
Can you explain that?
And adequately disclaim.
So when you say net of fees and expenses, explain that.
So, again, this depends on the facts and circumstances of your particular investment that you're offering, the investment vehicle you're offering. But let's take the example of a 2 and 20 fund. So if you were offering a 2 and 20 fund, which would have a 2% management fee and a 20% performance fee or incentive allocation, you need to present your performance returns in any marketing document that you're providing to potential investors, net of those expenses. You have to show an investor what they would receive after you take out your costs. And it's not just the fees. As I said before, it's fees and expenses. So you also have to account for what the investment expenses are and operational expenses that you have with respect to your funds. And this all gets back to whatever you have in your prospectus with respect to expense allocations. But those have to also be baked into that performance number. So let's say you had a 10% return in a given year on a gross basis. Well, yes, you did have a 10% return, but that's not what the investor would have received. The investor would have received that 10% return less a management fee, less a performance fee, and less the expenses. So you must show that number, that net number. That's a requirement that's been a seminal part of the SEC's approach to marketing documents since the mid-'80s. There is a no action letter the SEC issued in the mid-'80s called Clover Capital. Almost all marketing documents or marketing rules flow from that seminal case. There have been subsequent cases since then that the SEC has built upon, but that core basis for how you present your performance is critical. Now, some of you may be thinking, well, I want to be able to show my gross performance. You can show your gross performance, but you must show it with your net performance, and they have to be featured with equal prominence. So you can't have pages and pages showing gross performance and then have a footnote on the last page stating that net of fees would have been something different. If you are going to show gross performance, say in a chart, that you have to have a column in the chart for gross performance and a column in the chart for net performance. They have to be side by side, and it has to be adequately disclosed on that page. There should be a footnote indicating that the net performance is what an investor would have received had they been in the fund.
It's all about transparency, right? I mean, you have to give somebody a full snapshot. What about, I work for a manager, and I'm a PM at a big shop, and I work for it, but I want to port my track record over. How does that work?
So again, if you are if you want to reference your prior track record, let's say you're launching a new fund, and you were working for either a different manager or you had a different fund product or whatever. First of all, you have to have permission from that manager, from that employer, to take the information. Now, it's not just getting the actual return data. What you have to have, what the SEC requires, is that you have the return data, but you also have the data, the underlying data, to back that up. You have to have auditable records of that performance data, and that's critical. You can't just state it without having something to point to. An investor may not ask for that information in particular, but the SEC certainly will during an exam. They will say, can we see, you have several years of return data here from prior to launch of your fund. Can we see that information? That's the first step. The second step is that, as I mentioned before, it has to be, and this is a two-part step, it has to be a strategy that you were directly responsible for or involved in, that you had investment discretion on. You couldn't have just been the analyst on it, you had to actually be a portfolio manager. You could have been a co-portfolio manager, but you had to be involved in the actual investment decision-making process. So that's the first part. I just blanked on the second part.
No, sorry, the second part. So the first, you have to have full discretion, you have to have permission. That if you work for somebody else, you have to have permission to port that over. Now, when you're negotiating seed deals, any of you? Go ahead, bud.
Well, I was going to say, the second part was basically built on the first part, which is that it has to be the same strategy.
Yeah.
It can't be, you couldn't come from a technology fund and then launch a new fund that, say, is in the consumer electronics space, and you're like, well, that's, or consumer strategy that has a technology focus, and say, oh, this is the same strategy.
It's so disjointed. And again, if you're negotiating a seed deal, negotiating some type of sub-advisory or otherwise, always have in there that you own the track record, right? That you can port the track record over, that you don't need permission. And having full discretion is important. There are cases, and I don't want to bore you with that type of stuff, but there are cases out there, one in particular where someone was sued to prevent them from using the track record because they won. The company won because they said the PM didn't have full discretion because the PM still had to clear trade with the owner of the firm, and for everything that they did, even though it was all their ideas, and they managed to book. So keep that in mind. All right. And Blue Sky, a lot of guys don't even know what it is, man. I mean, a lot of people don't do it and still do it anymore. But Blue Sky is one of those things where it will be asked on a DDQ, and it's just one of those things that you have to comply with. It's it's state filings. We're big believers in complying with it, crossing every T and dotting every I. All right. So let's go forward. All right. Private placements. All right. Let's go through the Advisors Act just for a minute or two, if you don't mind, and then we'll talk about that. There are, for the most part, and let's just go. There are registered investment advisors, right? And then there are ERAs. Can you explain, Elliot, for the folks in our listening audience, kind of the difference between a registered investment advisor and an ERA, and how that comes into play?
Well, basically, you're dealing with it's essentially a level of management. So under Dodd-Frank, the advisors that are over 100 million must register as investment advisor with the SEC if they're managing SMAs and private pools of capital. Certain advisors that are under 150 million, so long as they're not managing SMAs, they're only managing private pools of capital, can register as an exempt reporting advisor. Now, exempt reporting advisor has slightly lower thresholds or maybe threshold's the wrong word, but they have slightly lower requirements as far as the compliance infrastructure that needs to be in place, reporting requirements on the ADV. You may find that, especially if you're a smaller organization, for instance, you don't need to have a CCO designated. You don't have to hire a CCO.
That's the Chief Compliance Officer.
It can make it easier and more inexpensive for you to run as a smaller manager. But once you get into those levels, those thresholds, you do need to think about the regulatory environment. If you're only running, say, 25 million, you're going to have different regulatory oversight or regulatory issues as far as filings and SEC oversight than someone who is now crossing into the 100 million, 150 million level. And once you hit 150 million, you are obligated to register as a full RIA.
Now, again, what has happened really since Madoff, kind of post-Madoff, and we never saw it before, but there are a lot of folks now who will want to be registered, right? Well, we never saw that before. And you may be in the listening audience thinking to yourself, well, that is just plain crazy. And it's not. Because what it does is, I can't stress to you enough, where investors are now looking, are you registered? Is there some type of oversight on you? Are you following rules and procedures? Are you following compliance? And one of the first telltale signs is, yes, I am registered. Yes, I have to follow this body of law or guidelines or guidance or what have you. You know, and again, we're lucky to have Elliot here, from a former GC CCO, your perspective, complying with your regulatory obligations, right? I mean, once you're up and running, how hard was it? I mean, a lot of folks want to know that, right? I mean, how difficult was it for you to stay on top of things?
Well, so I came from an environment where I was at a full, a full mainline registered investment advisor, not an ERA.
So SEC registered.
SEC registered investment advisor. We were leanly staffed, but I had, we because we were an RIA, had to have a standalone or designated chief compliance officer, and I fulfilled that role as general counsel and chief compliance officer. Generally speaking, if you're looking to build a business or build an RIA, putting into place the infrastructure, the compliance manual, the policies and procedures is onerous. It is difficult. It's not super streamlined. It's also definitely out of your wheelhouse. If you're a portfolio manager, this is not something that you may have had exposure to compliance in the past at various organizations you worked for, or if you were at a fund or bank or some other asset manager. But in reality, if you're running the enterprise, if you're the principals, putting that infrastructure into place, you really do need assistance with that. And that's someplace where we can add value as a law firm. We have a number of different products that we can offer that are at different price points, obviously, not to pitch that, but that enable you to get in place what you need with the least, in the most streamlined fashion, the least heavy touch that you need.
But it's going to be unique to you.
Well, that's what I was going to say.
I knew you were going to say.
Well, my next point was a lot of folks are thinking, well, maybe we can just go to a compliance consulting firm, and there are many of those out there, and there are many that are excellent compliance consultancy groups. But the biggest concern that I have as a lawyer when I look at these things is that the SEC requires that you not just have an off-the-shelf compliance manual. Your compliance manual policies and procedures must be reasonably tailored, or it must be tailored to your business to reasonably detect and prevent compliance violations. So it's not just a matter of you going and buying an off-the-shelf compliance manual. If you talk to a consultant, they approach you and say, hey, we'll sell you this manual for X dollars, that's not good enough. The SEC, when they come for an exam, if they see a manual, and they see them all. When they go for exams, if your manual is one of these off-the-shelf manuals, it's going to look very familiar to them. And it's not going to take them very long to start poking holes in it, especially if it's so off the shelf that it hasn't been customized to your business, and it has information in there that's not even relevant to your business, and it has policies and procedures in it that you're not even following because they're not relevant to your business. That's a huge red flag, and that's an issue that's going to cause you pain in the future.
And again, I mean, you can't afford reputational risk. Now, we're not selling insurance here, so I don't want to sell fear, but you can't afford. We want to see all you guys. We want to see everybody on this call to be super successful, right? Raise capital and just hit home runs. And I will tell you that if you have any type of hiccup in your regulatory body, if you will, right, in your background, it's going to create a lot of heartburn for you and make it very difficult for you to raise capital.
Exactly, Paul. And this also gets to the point of the sword and the shield for compliance, because when you're talking about your compliance manual is a sword in the sense that it's a sword and a shield on both sides, both for the regulator and your investors. For the regulator, it's a shield to show that you have put in place the policies and procedures that are necessary and that you take your compliance responsibilities seriously. It's also a sword for the very same reason. You're able to assert to a regulator, should they come for an exam, that you have in place and you are following the rules as they're required. With your investors, on the other side, as we mentioned earlier, they're going to be looking for these things. They're going to be looking for a compliance infrastructure, for a culture of compliance in your business, for a compliance manual. Now, those sorts of things are things that you have to show. They're baseline, basic aspects of your business on the back office side that are critical for you to operate.
And there's a lot of folks that will not only outsource some of that, which is fine, some of your middle back office, right? We have a lot of clients who do that. They'll outsource their compliance. We have a lot of clients that outsource where you act as a backstop to even their CCO. But irrespective of that, if you're going to outsource it, you still have to know it.
Yep.
And you still have to be aware and monitor. And how many times you've seen that, right, Elliot, where people are not monitoring their middle back office,
right,
and they get questions on it, and they're not able to answer it or attack it, or whatever.
Right. No, so that's very true, Paul. I mean, that gets back to what I said earlier. If you have a manual and you say you're doing it, the SEC is going to expect that you are doing it. And if they come in for an exam and they see that you're not doing it, or that you're not doing it the way you say you're going to do it, that's going to be a deficiency. And if you have enough, look, most RIAs, when they have an exam with the SEC, receive some sort of deficiency letter. I think it's fewer than 1 in 10 that receive a clean exam with no deficiencies, because there's always something that can be improved. But if you have a manual in place, and the risk, of course, if you get one of these off-the-shelf manuals, and you're not doing something you say you would be doing, then the SEC is going to ding you on that. It's going to be a failure to supervise. It's going to be a failure to adequately enforce your compliance policies and procedures. You're going to have to disclose this to your investors. You're going to have to disclose this in your ADV and other documents. And it's going to causes that reputational risk, or that ability for you to attract future capital to manage.
So you're going out after your investor base, right? And we're going out and we have our pitch book done. We have our great offering documents done. our offering documents are tight. We know what goes on inside of there. And you're going out and you're lucky enough where you have a trader in your shop, because you're going to get that question. If you're a single shingle and you're out marketing and somebody's going to ask you, well, you're here in front of me, who's trading my book, right? And that single shingle guy, it's a dangerous thing in a way for a lot of these folks. So now we have either you use an outsourced trader or you have your own trader internally. That trader makes a trade error or otherwise. I mean, you don't catch it. Ellie, who's responsible for that?
You.
Who?
You are.
Right, because you have a duty to what?
To supervise.
To supervise. Yeah. So your duty to supervise really comes down to your ability to maintain adequate controls, understanding what's going on inside your shop. Sell that to your LPs. Yeah. Tell them you know what's going on, and here's how we do it, and here's how we check on things. Let me just say, one of the funniest stories we represented, and again, attorneys always tell you these old war stories, but I will say to you that we had a client, they ran about $5 billion, and their head trader was also the person reporting all the trade errors. So when I came in and I was asking him about it, I was like, well, that seems a little bit peculiar to me, in as much as if they're, how many people would want to raise their hand and say, I made a mistake? Very few. And even though this person actually was a very honorable person and did catch one trade error that was considerable, that was a major compliance issue that we came in and corrected right away.
That's a very good point, Paul, and it gets back to, look, not all circumstances, not all situations are going to be the same, so you may not be able to have a full panoply of infrastructure in your back office that you'd like, but separating out your compliance function from other functions within your organization is very critical. One thing I just want to point out, I imagine some of this that we're discussing could be overwhelming or cause for concern to some of you. You may be thinking, oh, I'm not doing that, or I need to think about that more. Those are sorts of things that we're happy to discuss with you. Again, when we talk about having a tailored compliance manual, one of the services we do provide is we meet with our clients, we understand their business, we understand their investment strategy, we review their documents, and we help them tailor that compliance manual so that it fits within their business. And then, Paul, going back to one of the things that Paul asked me earlier about getting this up and running, how difficult it is that? Well, yeah, there is some heavy lifting at the front end of this, but then there's ongoing care and feeding of your compliance strategy and infrastructure that you need to think about. And part of that is regulatory. The SEC requires that you conduct an annual review, that you review your compliance policies and infrastructure and make sure that it's adequate to your business. You can't ignore this. This is a very important issue. The SEC will look to see that you've done this. They would look to see some sort of written report, and that gets to my next point. The SEC the SEC doesn't believe it unless it's written down. So keep scrupulous records of these things. If you have an annual review, document it. Put a memo together. Talk about the things you looked at. Talk about the parts of the compliance manual that you thought about, that you tested. Part of this is a risk assessment, which is a second prong of the annual review, but you should conduct a risk assessment of your business. We can provide you with a risk assessment matrix, which enables your questionnaire, which enables you to go line by line and think about these issues and figure out whether you have them adequately protected against. And if not, then you can fix them. And then on an annual basis, you will have conduct your annual review. You will make amendments to your compliance manual as necessary on an annual basis, or more frequently if necessary. And you'll move on from there.
Yeah, and you're going to get investors asking you questions about it. And I would tell you one other thing with the annual review. Look, you should really, whether you're a single shingle, you can have a meeting with yourself, or you have a large staff behind you. You want to get your entire staff involved in your compliance and your review. Go over your compliance deck, and get people to understand that it's important, because that will kind of bleed out into your clientele, and they'll get a good understanding of it. We're getting short on time, so I want to clip through some stuff. Go ahead.
Yeah, just one more point on that is that in addition to the annual review, you also have a requirement that you must provide adequate training for your personnel. So you should run at the bare minimum an annual compliance training. Preferably, if there's other issues that need to be covered off on a more than annual basis, you cover those as well. but at least no less than annually, you should have a training for all of your employees.
Totally true. And make sure it's same thing with your audit. When you get your audit done and everything else, go through your audit with your auditor, get a good understanding. If they do any type of gap analysis, pay a little extra to get that gap analysis done. I'm a big believer in whether, and you should go through your counsel to do this, but I'm a big believer in getting a mock audit, and that basically can go through it. I don't have enough time to go through what a mock audit does, but it's, for the most part, it's very
simple. You can have someone like us come in, or even a compliance consultant, but I think having a lawyer do it is better for a number of reasons, including protecting attorney-client privilege. But we can come in and conduct essentially an SEC regulatory exam, or a lighter version of one, just so you can see what it's like and you can prepare yourself and at least be in the right mindset for when it does eventually.
Yeah, it's a gap analysis. And the gap analysis is key. Remember, SEC comes in, they go through your stuff, any deficiencies or what have you. A good investor is going to do what? They're going to ask for that deficiency letter, and they want to see exactly where your foibles are, you've tripped up. And they want to make sure that you're not recalcitrant, that you've done things, that if you've had issues, that you've fixed them and gone forward from there. Let's just quickly hit some hot topics. Marketing solicitation. What is common mistakes there?
So your marketing documents are obviously one of the first things investors are going to see about you, in addition to your ADV brochure and a few other documents. You want to make sure that this is low-hanging fruit for the SEC. There's no reason your marketing documents should not be SEC compliant. You need to be concerned about a few items. First is you want to make sure that you're not sending it everywhere in the world. You want to make sure that you have some sort of pre-existing relationship with the people that are getting this document, or some sort of cap intro relationship, because you don't want to blow your private placement exemption. If you do, if you have bad performance following that, you're basically giving your investors a put option. They get rescission rights. They can actually ask for all their money back from the original investment because it wasn't a proper private placement. So don't risk that. Keep your marketing documents close. Don't blast them out to the world. And
have them reviewed. Have them reviewed. If you're going to make changes, have them reviewed. And again, this is not a solicitation. This is really us telling you, because we want to see you successful. Right. Have them reviewed, because any hiccup in it, and you have to keep them. Right. Year one, all your marketing material goes into a file. Year two, and the SEC has the ability.
All versions of your marketing material must be kept for a period of 7 years. 5 to 7 years.
Yeah. Social media. Let's go through that.
I also just want to point out one other thing is a lot of folks in their marketing materials want to have case studies. They want to be able to show their best ideas. Please don't fall for that trap. The SEC will deem that to be cherry picking. Cherry picking is a concept of you presenting only your best performing ideas and not showing your winners but not your losers. If you are going to show that sort of information, it must be done on an objective basis. So you could say, so for the past year, these are the 4 or 5 best performing positions we had, and these are the 4 or 5 worst performing positions we had. You must show both sides of the coin. Social media, I would be very hesitant. Again, look, I know that people view it as a means to raise capital. I'd be very careful in the way you use it. You should talk to a lawyer, us or someone else, before you go onto social media to talk about your investment vehicle or the fact that you are offering investment advisory services, or even your investment ideas.
Yeah.
You want to make sure that information you want to make sure you've thought about how that information is being presented or used.
And one thing on that, and quickly, we are very tight. Look, you're going to have your counsel look at stuff. Also, think about hiring a marketing firm that can actually put together your pitch book and everything else, because it makes it look much cleaner, right? And it looks tighter and more professional. Again, your perception becomes a reality on it. Disclosures, expense allocations, all of that we kind of went through already. You're going to have to be able to depict everything fairly and accurately, exactly how you do it. Again, expenses used to be where you could throw in the kitchen sink for your expenses and how you allocate it, not anymore. Your trading, again, best execution. You always have to be in contact with your prime. A firm like Interactive is great, and they use technology to really drive down costs, and they have great execution. But you should know exactly how that happens and what they're doing,
and be able to talk about
it. Correct, man. AML, again, you're good if you're using a good admin, which I'm sure all of you are. Your admin should help you get through all of your AML questions. Your corporate governance, books and records, keep them, update them. Okay, don't rely on yesterday's books and records and corporate governance. You're going to get a good investor, that one whale that you've been waiting for, man, because and they're very impressed by your trading, impressed by you, and then they come into your office, they go through all your material, and it looks like my 11-year-old son has been keeping the books and records.
Or it's just out of date. It's not updated.
Yeah.
You make sure that everything is updated at least annually at a minimum. Certain types of documents like your DEQ. And others might want to do more frequently than that. On the books and records front, also, don't forget that you do have a regulatory obligation to maintain your books and records. That includes all emails, instant messages, other types of communications. You want to keep those things, or you have to keep those things for a period of years. They're readily accessible, so the SEC or other regulators can look at them. Your investors are going to look for that. And just one little piece of free legal advice that I like to give to people when I speak about books and records. If you have a system in place, if you're using technology where your voicemail on your phone is automatically sent to your email as an attachment so you can listen to it through your email, my advice to you is after this call, you turn that off. And here's why. First of all, it takes up a tremendous amount of space within your server. But the other is that voicemail is not considered a book and record by the SEC at present. But once it's on your email system, it is. And if it's on your email system, then you have to save them all. And that can be a problem. If you accidentally delete them, now I'm not saying you shouldn't do it because you're trying to hide something. I'm saying you shouldn't do it because if you do inadvertently delete emails or voicemails, then those are no longer part of your books and records that you're obligated to maintain and preserve, and the SEC could cite you for that. So make your life easier. Don't do it. Likewise, heavily consider whether you need to be using instant message. If you are using an instant message system for any part of your business that has to do with your investments or trading activity or marketing activities, you must maintain and preserve those as well. If you are not using an email archive system, you need to get one. And if you are using instant message, you need to make sure that email archiving system also captures those instant messages. If you're not, then you're not maintaining your books and records.
Correct. And the last one I want to hit, and then we got to hop in, I think Amanda's going to jump in, is valuations. So you have your valuations. Most of you are level 1, which means that they are freely tradable, and there's a market quote on it all the time. I mean, but if you have level 2 or level 3, you have to consistently apply your valuation across the board every time, right? No matter what, up, down, whatever it is. Your valuation is a huge hot button topic for the SEC.
Right.
You need to have your auditor, review things. You got to have a great guy like Jeff Parker who's involved. A guy like that who really understands it in and out. Understands the tax portion. You have to use that. You have to use that team, your auditing team, to help you build out that valuation model.
So the critical point there that Paul was pointing to is that there is no specific valuation methodology that you must use for certain hard to value assets. But whatever you do choose to use, it should be generally accepted in the industry, and it should be consistently applied. So you can't use it one month because you liked it, because it was more favorable to you, and then the next month you go to a different valuation methodology for that hard to value asset because that version is more favorable to you. This is real low-hanging fruit for the SEC. They now have very sophisticated methods of analyzing your data against your brokers, or your prime brokers, but also against the rest of the street. And they'll get red flags on that stuff very quickly, and you'll have a deficiency letter for that sort of thing.
Yeah, it's a big thing. All right, we're just about out of time. So Amanda, if you want to jump in, I know that there might have been some questions. I don't see them up on our screen.
Yeah, I can read those out for you, Paul.
We would like to add that, of course, we are available offline. If anyone has questions, our contact details are provided in the materials. Feel free to reach out. We're happy to chat with you. We can answer general questions. We can also answer more specific questions if you have them.
So one of the questions, Elliot, that came out of the gate was how early in the process should the fund manager look to get an audited performance? That comes up a lot when they're trying to attract investors. Should I have my track record audited on day one, or should I let myself run for a year and then get it audited?
Well, that's a
How
good
best to
question.
proceed?
That's a very good question. The issue is, and typically in marketing documents, the performance you're showing in your marketing documents, you should also have a disclaimer that states that it is unaudited and unverified, because you're typically going based on the information you have from your prime broker or from your internal order management system and trade blotter. But you need to make sure that that is accurate. I wouldn't say that you need from the get-go, month one, that you need to have an auditor come in and verify those values, but certainly on an annual basis, it would be very beneficial to you from a marketing standpoint to be able to say that your returns have been audited. That is a helpful fact. But I can say that even for much larger funds, they don't do that on a rolling basis. So it's not uncommon to have a marketing pitch book that shows your returns, and it has a footnote that states that the net returns listed are unaudited and unverified.
And again, also with your auditor, let me just boil it down. While your mom might believe everything you say, no one else does. So your auditor is a verification, right? That and getting a good auditor, especially.
You should have a PCAOB member auditor that's basically part of the regulatory organization for certified public accountants, and they should be giving you an unqualified audit opinion.
100%. What else, Amanda?
There's a question from the audience. They wanted to know how they should coordinate the messaging of their sort of compliance and controls and due diligence in working with their outside vendors, like their fund administrator, if they have a third-party marketer, or they're working with an auditing firm and they're working with Sadis and Goldberg, let's say, for legal counsel. How do they make sure that everybody is on the same page and that the messaging is consistent to the investor that has come and signed subscription documents?
It's a great question. Whoever asked that, it's a fantastic question, because we do see a lot of cross chatter when you come across it quite a bit. What we always recommend, and Elliot, finish it out, but I love when I'm working with somebody, right? We're working with a manager. One of the first things I do is find out who they're using for other service providers, and I get on the jump on the horn, and I speak to whomever they're using, or I go out if they're in the city here. I go out for drinks or dinner with them because I want to know who they are, what they're doing, and get on the same page with the manager and how they're going to approach everything.
It's critical, first of all, that you maintain, as the manager, you maintain oversight of all of this. So you need to do due diligence on all of your third-party service providers on an annual basis, the minimum, but certainly when you onboard them. And then from that point forward, you want to make sure that you maintain control of all your documents and that they are working off the same current documents that you have. So that's the first point. The second point is, and I'm not sure if the question was asking this, but how do you ensure that they're complying with your various compliance obligations? Well, part of that is how you draft your service provider agreement, that you put requirements in there that they do certain things for you or that they do them at a certain service level. And we can help you with that. Those are the sorts of things that you want to make sure your administrator is, if they're delegated to do your AML, for instance, that they are doing the AML process in compliance with regulatory requirements and in compliance with your compliance manual.
Yeah, and to that extent, I will say to you, and it happens, don't let it happen to you, is that I thought you were doing that, right? I mean, I thought, hey, admin, I thought you were doing, or hey, audit, I thought you guys were handling that. And again, you know exactly what everybody is doing because it's your business.
And this is the value of what we discussed earlier, this concept of a compliance risk matrix or compliance questionnaire. These sorts of things, these risk matrices, we have built these out with all of these topics, and it has the question: who's responsible for this? What are they doing? How are they doing it? And have you confirmed that? These are the sorts of things you want to be looking at. It does seem overwhelming, but there are ways. You can bite it. You can do this in bite-sized chunks, and there are certain pieces of low-hanging fruit that are easy, and that you should have as a matter of course. And as you grow and as you develop, you can build out your compliance manual to be more sophisticated and to have more issues that are relevant to a growing business. But from the get-go, if you're a smaller advisor, your compliance manual footprint is not going to be overwhelming. It's just something you need to have in place. And it's sort of like flossing. Well, look, I'm terrible about flossing, but I know it needs to be done. My recommendation to you is floss.
And when it comes to do it, and it'll grow your compliance. One of the questions just popped up on here is, what's your cost and first year setup costs or what have you. A lot of it is going to be dependent upon what you're doing as a strategy. A lot of it is depending upon how what you're doing, but you got to look at it this way, right? I mean, if I told you you have to spend $2 to make 10, you would do it, right? And you have to figure that you need to do this. So what is your first year cost? A lot of it is going to be dependent upon what you're doing, right? But none of it will be dependent upon how good of materials you have, because there's only one answer. It's very binary. You have to have excellent materials on it and be able to do it. Amanda, any other questions?
And we're happy to talk offline about fees for those sorts of things with anyone who's interested.
Absolutely, and again, I'll emphasize to the audience that Sadis is readily available after the call and really at any time to be contacted. They're located in New York and easily accessible. One of the things that Paul alluded to was about knowing your investor, and since we have a lot of offshore funds, someone had asked, what are some suggested ways to carefully vet offshore investors when launching a fund? Does it run sort of in parallel what you discussed, or there's some other issues that they should keep in mind?
So yeah, there's Know Your Customer and AML are run hand in glove, and it is critical. I know we've run over here, but when it comes to AML and knowing your customer, especially offshore money that's flowing from an offshore source, there are a number of steps you need to take. A lot of that would be baked into a standard AML policy and procedure in someone's compliance manual, and that might need to be customized to a specific source of funds or region of the world. But generally speaking, at a bare minimum, you want to do an AML check on them. You want to run them against the Office of Foreign Asset Control with the Department of Treasury, the OFAC list. It's an easy way. It's available online. You can take the investor name, and you need to know the ultimate beneficiary, a beneficial owner of the entity that's giving you money.
Can you explain that just quickly?
Okay, so the money's flowing to you from some sort of special purpose vehicle or corporate entity. You also need to run up the food chain to somebody with a heartbeat.
Who's controlling it? That's
so somebody who's controlling it, who the beneficial owner of that capital is. It's not good enough to know that it's Bahamian money source ABC Limited. That's not sufficient. You need to know who owns that entity. You need to have a living, breathing person behind it, and you need to do an AML check on both the entity and the ultimate beneficial owner. You can do that by looking at the OFAC list. A lot of this will be covered off in your subscription documents, where they have to provide this information so that you can do this this check against the source of funds. But that is, and that's more difficult for offshore than it is onshore. But it's something that's routinely handled, and there are many administrators can help you with this. I'd say all the administrators, all the mainline administrators can help you with this, and there are certain other organizations, including us, that can help you with that if need be. But it's that's sort of the first step, or the easiest way to approach
that. And of course, I mean, the smell test, and of course, and just doing some basic background checks yourself and due diligence yourself. Anything else, Amanda?
No, that's terrific. Paul, we really want to thank both yourself and Elliot for coming today and spending time with Interactive Brokers, our client base, as well as with the hedge fund and investment community. We really appreciate your comments, and we value your guidance and feedback as our institutional global customer base looks for direction, and they look to really form their new funds and to manage or expand or add additional funds. I'd like to spend just a few minutes discussing the following, if that's okay. Briefly, Interactive Brokers Strength and Security. I just want to talk about a couple of the account types that we offer for fund managers, our account management and reporting capabilities, a couple of more popular programs that we offer to all of our cleared accounts. And lastly, I just wanted to explain that I have included a couple of key links on the Interactive Brokers website that you can copy-paste to your browser as you navigate through the firm. Interactive Brokers has over $6.7 billion in net equity capital. We have no subprime risk. We accept no TARP funds. The firm executes over 1 million trades per day, and we have over 565,000 clients worldwide. We currently support access to 120 market centers, and we have a real-time margin system, as Paul alluded to, that continuously enforces trading limits. Next screen. To open an account at Interactive Brokers, you simply would go to our website, www.interactivebrokers.com. You would select whether you're a hedge fund or a mutual fund account. You would go to open an account, and you would start an application. You can open your account using fully or semi-electronic means. If you are signing the application, feel free to do the fully electronic version. If you're doing semi-electronic and someone else is signing, that would be the preferred method. The screen in front of you is for a single pooled hedge fund, and next to it is a diagram of something that we offer that we think is unique. It is the IB separate trading limit capability, and this really allows you to segregate different strategies within the same fund, all while tracking NAV performance. Next. The multiple hedge fund account type. This account type is going to allow you to block trade, allocate across accounts, pari passu, as well as have the ability to set up multiple funds all under one umbrella with a single TWS login for both your trading and operational needs. This account structure is going to be most helpful if you're managing or looking to establish potentially offshore funds down the road. Multiple trade views are available with the fund manager controlling trading and back office. If you think you'll be adding more funds down the road, this is really the direction that is most nimble. Lastly, we offer an omnibus hedge fund account type. Next slide, please. And this account type is really for fund managers looking to execute on behalf of multiple sub-funds with Interactive Brokers, and they're clearing with another prime broker. In that particular scenario, we're going to ask for audited financials for each of the funds, and we'll set up DTC instructions so that all of the trades automatically DTC flip over to the respective clearing firm. The screenshot that you're looking above, it talks about our customizable benchmark reporting. We don't charge for any of our reporting tools at the firm. Portfolio Analyst is a tool that where the manager can select benchmarks on his own, and it will report and highlight the portfolio asset allocation. It'll display the 5- and 10-day best and worst drawdown, as well as the beginning and ending NAV balance. A detailed portfolio analyst report will also include portfolio attribution. We also provide the following at no charge to our managers: activity statements for custom time periods. We have customizable flex statements that can be designed by the client and automatically delivered. Interest details, statements related to stock loan, risk and VAR reports, and more to what Paul alluded to. We provide transaction cost analysis reporting, and that's going to allow traders and advisors to evaluate their trading and slippage across multiple venues during the trading day. Next screen. From trade date to settlement date, our securities financing team is available to you on a 24-hour basis. In addition, our TWS, which is our front-end platform, will provide you with robust automated trading solutions. We actually show transparent rates in our stock loan. We have dedicated service representatives. Automated lending and borrowing tools give you the advantages you expect from Interactive Brokers. Next screen. Clients can easily view the number of shares that are available to short, as well as indications on the borrow fee rate directly on the platform. Clients can search for real-time availability online using our short stock availability tool. Upon placing an order, you'll be notified when a borrow becomes available. We have access to more than 60 different counterparties on the stock loan front, and we work with agent lenders, broker-dealers, and a variety of counterparties. Next screen. This is our stock yield enhancement program. This program is going to allow our clients to earn additional interest income on any fully paid for securities in the portfolio that they agree to loan out. Interactive Brokers will make the stock available on demand, as well as manage the risk of a potential merger, spinoff, or upcoming dividend in exchange for a 50-50 split. Clients can view the theoretical income that they can earn from participating in this program by simply running an SYEP report within their free Risk Navigator tool. This is a way for managers to earn additional interest income on any fully paid for securities. Next screen. This is something that comes up quite a bit. Our hedge fund capital introduction program will allow you as a manager who have a fund administrator, a 1-year audited track record, and at least $3 million in AUM or greater to participate in this program. Interactive Brokers requires that eligible funds who are approved for the program clear at least 75% of their assets with Interactive Brokers unless those assets are unsupported at the firm. You as the manager will have the ability to post performance directly on the Interactive Brokers website, as well as to be contacted by potential clients who qualify as accredited investors. They actually complete an accredited investor questionnaire online before they can view your fund, and who are potentially interested in investing in hedge funds directly from their IB cleared account. Next screen. This is our trader workstation platform. This platform allows for 24-hour direct market access to over 120 different market centers. This is Interactive Brokers' flagship product that we spoke about. The universal account that we offer offers the ability to settle in almost all major currencies. We've also developed a different look and feel, next screen, with our Mosaic platform. And this is very similar to other platforms that managers are used to using. However, it's highly customizable. And we do offer a layout library where you, if you're more options focused or stock focused, where you as the manager can create your own look and feel on the workstation and provide multiple views. We really want to thank you for attending this presentation. I've included those links that I spoke about. Please feel free to contact myself, Paul, or Elliot with any questions. I've worked with Sadis for many years now. Our details are listed at the end of the presentation. Moreover, I just want to thank everybody for coming. We plan to do more of these. And we really hope that Interactive Brokers will be your prime broker of choice. Have a great afternoon, and thank you for coming.
Well, with that, I want to thank Sadis and Goldberg for today's presentation, and thank you, Amanda, for making this possible as well. This is going to conclude our presentation today. I do want to remind you that we have been recording today's session, and each of you will get a direct link to today's recorded playback, as well as a link to the slides that were used for today's session. So with that, everyone, you can exit today's session using the X in the upper right-hand corner of your screen. Have a great rest of your day all, and thank you for your participation.